All right, so recording is live. We're here. Let me make sure I got my microphone and all that turned on. Okay. So we are in week 2 of July 2026. So we got some craziness going on. I just have this pulled up. I was watching the headlines earlier, just seeing what the news was that caused that spy thing. It was a Trump tweet. So we're not going to focus on that as much today, but we are going to focus on what to look for in an investment. So I'm going to pull up stock analysis, I'm going to pull up FinBiz, and I'm going to pull up the SEC Edgar database. And I have these links pinned somewhere, but I'm more than happy to post them here as well. So let me just do that really fast. Wrong button. There's that one. There's that one. And then there's that one. Okay. So I'm going to go to FinBiz last. I'm going to go to the stock analysis one first. And I'm just going to pick some companies. I'll let you guys pick some companies too, and we can just kind of look through them. But I want to tell you right now, the first thing I want to look for when I'm looking at a company to invest in is I want to make sure that they're making money. Okay, there's 3 core things that I want to look for. One is let me make that bigger as well. Is the company making money? 2, is the company keeping money? Well, I'll leave that pretty blanket topic as it is. Do the shareholders have access to that value? Okay. And there's 3 specific metrics we can look for right off the bat to kind of solidify these. So I'll just map them out for you first. The company making money is usually from revenue. If they're making money through other ways, that could be anything from selling equity or taking on lines of credit, whatever it is. Revenue is going to be the best way for them to make money because we don't want them to owe some of that money to someone else or have to pay it all back with interest, right? We want free money from customers or from clients that the company is able to put in their pocket, okay? And that's what funds the whole show. Is the company keeping money? This is where we're going to look for free cash flow. And this, in a very simple sense, is just the money that they get to keep at the end after all the expenses, taxes, payroll, mortgages, all that good stuff. It's what they get to keep, okay? And then do shareholders have access to that value? Those are things like dividends. Shareholder equity obviously is a big one. But we're mostly just focused on the dividends for this. Okay, so let's pick a company. You guys pick, just put a ticker in the chart of something that you think might be a good investment. First come, first serve. Unfortunately, I don't have the most recent Rest to Retire pick just yet, but I would normally just grab that one. So if we look at Pennybois, all right, share price $18.36. First thing we do is figure out, does this fit my schema? So I've got this portfolio set up. I know I'm putting 70% into investments, 30% into speculation. I know how I want to break up that 70%. Does Pennybois fill a slot that I'm looking to fill in terms of price, sector, and intent? Okay. If the answer is yes, then we can proceed. If not, I don't have to care about it. There's no reason for me to continue looking at it if maybe I'm already overloaded in that sector, or maybe if I don't need something, or maybe I'm looking for one last ticker to offset something in terms of income. I need something that will maybe depreciate or offer a growth potential. That's always the first element that I need to look for, is what slot does this fill? If it doesn't fill a slot, it goes right in the trash. Okay? So let's assume that we need this ticker, or we need a ticker of this sort in our portfolio. This passes that initial sniff test. Let's go ahead and look at I don't care about the chart yet. Let's look at the financials, okay? So the first question I'm looking to answer, does this company make money? So if I go to stockanalysis.com first and I pull up PBI, I go to the financial sheet, and then I'm looking at the income statement first. Let me make that a little bit bigger so you guys can all see it. Everyone see that okay? Sometimes the resolution's a little bit trashy on here. All right. I'm assuming you all can. If you can't, let me know. But if you can, we're going to move forward. So on the income statement, there's the income statement, balance sheet, cash flow. I don't really care about ratios or KPIs. Those are just calculations of what we see in here. Looking at the income statement here, see this little graph icon? If I put my mouse over that, it'll show me a chart of the last 5 years of their revenue. Okay, if I do the same thing down here for gross profit, I could see that, other operating expenses. So anything that's got this little chart icon, which is most of these, you'll see historical data as a trend, as a chart. Does that make sense? It's a bar chart. So if I look at their revenue, I can see right now their revenue is declining. Okay, that doesn't mean that they're struggling. It just means that they're not getting as much money from their customers and clients. So their sales revenue is most likely driving this, which means this is a red flag for me. It doesn't satisfy question number 1. So I need to look further into this company before I move forward with buying it, just to see how they're making money. Because if they're not, I'm not going to touch this as an investment. Okay. Now, question number 2. Is the company keeping money, right? Because they might make their money somewhere else, but it's not revenue. So I need to look at the free cash flow. And this, again, is the number of dollars that goes in their pocket at the end of the day after they pay everything. They pay all their properties, they pay payroll, they earmark some for R&D, they pay all their compliance stuff, they pay taxes, they pay X, Y, and Z. Everything that comes out subtracts from the free cash flow, and then what's left is what they can reinvest into the company itself for all kinds of other stuff, or they can give it back to shareholders in the form of maybe a buyback. So if I'm looking at the free cash flow, I can see this is a good number. So something is different here. Their free cash flow is $378.85 million. Their revenue is $1.877 billion. So they're still increasing the amount of money they keep despite making less from the general public or from their customers and clients. Okay? Sorry. So in the sense of, are they keeping money? Yes. They're just making a lot less. Okay? But 1.87 billion is still a pretty substantial number. It's just not as big as 3.674 billion post-COVID. Okay? So that kind of answers question 1 and 2. And I know that for question 1 here, I've got a red flag. Everyone keeping up so far? And like the EBITDA, that's the equity before interest, taxes, depreciation, and amortization, earnings before all that. This is more relevant for certain sectors like finance. It's less relevant for other sectors like consumer staples and things like that. So you don't always have to look at every single item here. That's kind of why I'm just showing you those 2 for right now. Snowflakes is 1 red flag. Okay, good stuff. And for a lot of investors, as soon as they see that red flag, they're just, I don't care, right? They can come back in a couple of years and see if the revenue is increasing without batting an eye. They don't need to fill that slot right then and there. Maybe they've got a bunch of things to choose from, and ideally we do. I personally wouldn't like seeing this. I'd need to look into it and see, well, why is the revenue declining and what are they doing about it? I see that they're doing something on the expense side so that they're keeping more of what they do make, which is good, but is that going to be substantial enough? Okay. So now I'm going to look at the balance sheet, and I just want to see kind of how those numbers are balanced. That's what the balance sheet is for. How is their income balanced against their outflow? So cash and equivalents, I can see here, is declining as well. So they're just not making a ton of cash. Like it's just declining. Now, again, it's a big number, so they're still making a lot more than I am. I don't have 1.87 billion. But where is it going? What is causing this disruption in inflow? And are they able to intercept that and change things before it crosses down and then end up losing more than they're making year over year? So far, they're not in that territory from what I can see. Now, first thing I'm going to look for is total assets and total liabilities. This just says everything that they own, everything that's considered an asset. If you added up the value altogether, you'd get 3.147 billion. So if they had to sell everything right now, assuming they could get paid dollar for dollar, they'd make 3.147 billion. Total liabilities is what they owe. So in this case, it's 4.041 billion. So they have a lot more liabilities, 33% more liabilities than assets. So technically they exist in debt right now from what I'm seeing. Now, liability itself isn't always a bad thing. There are healthy things like established lines of credit and other types of DFO or collateralized debt for financial obligations. So we'd really want to look inside of a lot of these numbers here a little bit more deeply to figure out if this is a good investment. But for me, that's 2 red flags right there. I always want to see a positive asset to liability ratio. Next thing I'm going to do, assuming I was comfortable enough with those, is I'd look at the current assets versus current liabilities. And the word current here just means for the next year. So if they add up everything that they could sell right now, if they had to, they would be able to get 1.129 billion. That's if they just sold everything that they had on hand. And then we're going to compare that against their total current liabilities, which is their next 12 months of scheduled debt, scheduled obligations, such as payroll, leases, things like that. They owe $1.818 billion. So if they sold everything they had right now, let's assume their doors close today on a Friday, okay? Monday morning rolls around, they've sold everything that they could possibly sell short term. They would offset this by that number. They would still owe $700 million, okay? Does that make sense so far? So these guys would not survive a year if they had to close their doors. They would survive for less than a year. They have a less than 1 current ratio. For a current ratio, I like to see above 1 at least, ideally above 2 or 3. Okay, so that's the third red flag that I see. And I've got a sneaking suspicion that if I look at the SEC filings, I might see my fourth and final absolute deal breaker, which would be a NT10Q, which we'll circle back to at the end here. I just want to make sure we continue walking through this stuff. All right, shareholder equity. And again, if you ever are confused about what you're putting here, or what you're reading here, you just put your mouse over this. Stockanalysis.com is a very helpful site for people that don't know how to navigate SEC filings. So remember when we compared the total assets and total liabilities? That is the shareholder's equity. That's what you're buying into when you buy shares. So you take the total assets, you subtract the total liabilities. In this case, we get a negative number, right? We subtract that, and you get a negative number by 893 million, okay? Now, if I put my mouse over here, I can see that number has been further and further going down into the negative. So this company is losing money year over year, and I don't like that as an investor. Now, their total debt has been a little bit all over the place, but it's relatively high, which tells me that they're probably operating on debt, which is something we identified early when we looked at that revenue, right? Net cash, that's going to be in line with the debt, right? A lot of it's just these guys are not doing well from what I'm seeing so far. And I don't really care about the rest of the stuff because I've already seen enough at this point to kind of make a decision and to say, well, it doesn't really look like they're investing in a bunch of stuff. They're not taking out debt for healthy reasons. They're not like their investments are declining. Their debt is increasing. Their revenue is declining. They're upside down on their asset to liability ratio, the shareholder equity. So it's not a good setup so far, in my opinion, unless I'm looking to short it, right? In which case, then I got borrower fees to contend with and all that. And that may not even be profitable. Net income, it's a little bit all over the place. It's kind of increasing here, but it's rough year over year. D&A, again, this is something that if they're heavy on assets, they're going to have a lot of D&A, depreciation and amortization. Depreciation is just the erosion of assets over time, the decay in value, and then amortization is the paying off early of the asset so that it can maintain its value against depreciation. Like if you buy a house, for example, and you get a 30-year mortgage and you pay it off in 15 years, you're amortizing that mortgage. And the house, if the value of the home goes down, you're depreciating that asset. Cars depreciate instantly. Computers depreciate. Homes typically increase in value, but not always. And so on and so forth. Operating cash flow, this is kind of a non-issue at this point. They're increasing, that's great, but they're still so upside down and stuff, it's just difficult to justify caring about that. Investing cash flow, we already know that they're not using a bunch of investments, so I don't really care about that either. Financing cash flow, this is kind of the nail in the coffin telling me that they're very heavy on debt obligations. So if I look at the SEC filings, I'm willing to bet that I'm going to see a bunch of 1.01s and 1.02s, 1.03s. And I'm already kind of seeing the symptoms of that here on their income statement. And then again, free cash flow here just is the same as the other tab. So free cash flow growth is great, but is it enough, right? And the answer here so far is going to be a no. So if I come over here and I type in PBI, this is the SEC Edgar database. This is where they submit all their filings every year. So the first thing I always do is I click 10K, and I just want to expand this and see, do I see an NT10Q anywhere? Okay, so I don't. I'm pleasantly surprised. I assumed a company like this would have one of those. And what that is it's a not timely filing of a quarterly earnings report. Quarterly earnings reports are handled internally. They don't have to send them off to a third-party auditor or an accountant, sorry. They can file them on their own, And it's just a way to be transparent to shareholders. They have to file them, but they don't need to go through all the extra hoops that they do for a 10K, which is the yearly filing, which is much more comprehensive and has to be audited by external parties and things like that. So that's kind of a yearly checkup on a company. So when I see an NT10Q, that just means that internally they can't get their stuff together, and I never want to see those. So first thing I see right here is when I'm just at a glance here. Sorry, guys. On the first two 8Ks, I see this 1.01. Like I said, we're going to see 1.01, 1.03s. 2.03 is the creation of a DFO, which is a direct financial obligation. So they're taking out a line of credit, or they're shuffling around something on a paperwork to offset what would ordinarily be reported as a debt. This is not a good sign to see a bunch of these, but it is a good sign if the company is able to use that money efficiently. In this case, we already know that they're not. Okay, so this is a really good example of what to look for so that we can filter out investments. All right, so if I were to open this up and to open this up, and we got a shareholder vote, blah, blah, blah. I don't really care too much about those, but they're always worth checking just for catalysts. We want to see the dates. So I'm not too worried about that, or 2.02s. Here's another 1.01 and a 2.03 together. I always like to open the 7.01s. Those are just extra statements that don't typically get categorized. Let's see here. 8.01s, those are just like generic press releases. Those are always good to look at too, just for dates, or maybe it's a phase update if they're on the biotech side. There's another 7.01. And, we're back in fall 2025 at this point, so I'm not too worried about this. I'm mostly hunting for 1.01s and 2.03s because this tells me what this company owes to other lenders. Here's an unregistered sale of equity securities. So they're trying to generate cash because they're not doing it on the revenue side. And those are things that I need to pay attention to as a potential investor. I'm not going to open all these 7.01s, but ordinarily you would. I just know that I'm not going to invest in this company. 1.02s, by the way, are the closure or the termination of an NDA. And that's where they've satisfied a debt or defaulted or something has resolved either for or against the company, but that debt, the obligation no longer exists. So here's a 1.02. And a lot of times what these companies do is they take out rolling lines of credit. So you'll see a 1.02 and then immediately a 1.01 back to back because they want to just re-up their loans to get better terms and better interest. So on June 23rd, okay, they added a credit agreement. Okay, so this is probably an example of that. You don't need to read all this stuff. And if you have to, just slap all this into a chat GPT to help you summarize it, or ask me or ask Lee or somebody to help you look at it. Okay, so this is $150 million incremental tranche A term loans. So $302 million total aggregate borrowings. So basically, they're just trying to raise the ability to generate cash. So good enough. That's not really a red flag necessarily. It's just a tactic that they can use because they're struggling on the revenue side. Let's look at this next one here. This is from May 18th, so 2 months ago. Okay, another MDA, February 7th. Okay, so this is an update on an old one. The loan parties, blah, 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 blah. Okay, the amendment extends the maturity date of their revolving credit facility and term loan A facility, which we just talked about, to the date that is 5 years from the amended effective date, and makes certain other blah, 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 blah. So they're just modifying their loan, basically their line of credit. Consolidated interest cover ratio, not less than 2 to 1. Okay. All right, so these are just numbers. Again, you can just put all this into ChatGPT to help you understand it. Basically, they're just pushing out the end of their loan, basically. So they got, think of like a HELOC, right? You take out like a 10-year HELOC. It's a loan. You can draw on that loan for a period of time. You don't pay interest on the full amount unless you use it. You pay interest on what you've borrowed, and then you could pay it off. And it's good for a certain period of time, and then the window closes, and then you can no longer draw on it, but you can still pay it off. So basically, that's what this company's doing. And they're just shuffling around their money so they can access other money. This one here is from March, so Q1. Okay, here's the offering. They had an offering back in March of senior notes, 7.25% senior notes due 2029. Okay, so that's all we care about. It's a couple years away. But then we got potential dilution of, is there a number on this? There is not. All right, just the dollar amounts, I guess. 476 million and 150 million there. So again, don't really care too much about that. I'm going to close that. This is from February. An additional 200 million. So they're just chunking up portions of this company for senior notes in 2029. So this may provide a rocky future if this company doesn't have something in their 8Ks that indicates that they're able to generate money from other sources, or they're just going to keep putting these out. And they're not really investing in anything. So I don't know how they plan to cover all these other than selling assets, which is going to further disrupt their shareholder equity. So shareholders pay first, company pays last. Okay, just saying they're doing a lot of amendments. This is pretty routine stuff. It's all just they're publishing small changes to their lines of credit. Okay, this is from August 2025. So again, we're pretty far back here. More of the loan convertible senior notes due 2030. Okay, I don't really care too much about all these. I don't really see anything significant here. Okay. And then the sorry, the unregistered sales of equity securities. This is back in February. Okay, so this is a purchase agreement dated August 5th. So again, they're just kind of updating people. They had a maximum 20.5 million. Maximum. Okay, so again, just more dilution, right? More dilution, more cash raising. Okay. And then this one is from February again. So again, I'm not going to go through all these. I think we have a pretty clear picture here of what we don't like, at least what I don't like. Does anyone have any other counterpoints about this company that they like? Do you guys all see the value in looking for red flags first before even looking at a chart? Because the chart means nothing to me if I don't plan to hold this long term and have the shares appreciate. And the shares will only appreciate if the shareholder equity is met by market sentiment and people negotiate the price higher up to that valuation level. So until that happens, there's nothing for me here. Only Snowflake. Only Snowflake is here. Taken off your list? Okay. And again, it may turn around. You know, I haven't looked at any of the press releases. I don't really trust those either. I just see the pattern in declining revenue, and I see the dilution and offering of notes for the next 5 years, and I see that shareholders are going to end up paying that. So I personally would be passing on that one. Yeah, let's jump around. WHR, Whirlpool. Okay, let me just go back here to the SEC database. WHR, I'm just going to pull this up. And if you're looking at FinViz, for example, you can just pull this up and kind of get a snapshot right off the bat. I can already tell right here. According to FinViz, the current ratio is less than 1. I would probably pass on that immediately, but let's do some due diligence. Let's look at it. All right. So first thing I'm going to do is I'm going to look at the overview just to make sure there's no like glaring red flags here. I see their net income is up significantly. That's a red flag because I just have to look and see what's going on there. Not sure what that's about, but it's a big number, and that means it's an anomaly. They got earnings coming up at the end of the month. That's a good thing to know about ahead of time. I can mark that. All right, let's look at revenue. So I can see declining revenue, right? Let's go back to those 3 questions. Is the company making money? We look at revenue first, then we look for other forms. And like we saw with the other one, they were making money by offering portions of the company that they would have to pay later by selling assets. Gross profit, declining, operating income, all over the place, but it's overall consolidating. Don't really care too much about that. Free cash flow. Is the company keeping money? The answer is no. They're having less and less cash in their pocket. Now they're taking money out of their pocket and putting it into operations or whatever is costing them a bunch of money. Dividends per share, they do offer dividends. That's starting to decline. Not the end of the world, but we'd want to look at that because the dividends will suffer first. Balance sheet. Do they have declining cash? Okay. Do they have investments? No. So let's look at their total current assets and total current liabilities. Total current assets is 4,969. Total current liabilities is 5,659. So they're less than 1, right? Which means if they closed the door and sold everything they could sell and had to pay all their debt that's scheduled for the next year, they would not survive for a year. Okay. Total assets, 16.177 billion. Total liabilities, 12.405. So this is a positive number. That's okay. That's probably the only reason they're still offering a dividend. So in this case, they have a positive shareholder equity for now, and they have a negative, a less than 1 current ratio. I can't say negative because it's still above 0. So how do their assets look long term? Pretty flat, slightly declining. How do their liabilities look short term? Slightly declining. I like that. That means that their liabilities are decreasing over time gradually. It's not tremendous, but that's a good 20% decline over the last 5 years. And their assets are increasing about 25% over the last declining 25 or 20%. So they're kind of in line, but the liabilities are speeding up a little bit more to the downside. And then, of course, shareholder equity, of course, is just the difference between those two numbers. Net cash debt, that's big. $6.5 billion. Not a fan of that because that's a good number out of that number. I don't like that, and that's half their liabilities right there. So the other half is, other stuff. All right, net income. Again, that's the number we already looked at. It's kind of consolidating. Give me just 1 second here. I gotta cough. Pause on the microphone as well. All right, I'm back. Sorry about that. I just didn't want to cough on the recording either. Okay, so operating cash flow, negative. It's declining, right? They're not able to keep cash. They got to spend all and stuff. Investing cash flow. It doesn't look like they're putting a whole lot. They're putting less than $500 million into stuff, and they've got $6.5 billion in debt. It looks like they've repaid a chunk of their debt, long-term debt. So this tells me if I look at the filings, I'm probably going to see a bunch of 1.01s, 1.02s. They're going to roll those lines of credit, and I'm probably going to see a hit on the dividend side. Financing cash flow, they're not okay. So they're not really using their debt, their healthy debt, efficiently. So it's another blah, right? Maybe not rule it out completely, but we got some red flags, right? All right, let's look at the dividend. You said, they discontinued it this year, or they will? Yeah, more than likely. 6.57%, not terrible. It's a $41 stock, $2.70 annual dividend, paid out, no frequency. Okay, it looks like it was quarterly. And it had a negative dividend growth, obviously, because they're going to take it out of shareholder pockets first. Looks like it was about a 90 cent to $1.75 declining. Yeah, not what I like to see on a long-term chart, because we know that this company is not a growth stock because they're struggling, and it's not a dividend stock for income because they're taking away the dividend or they're reducing it. So in this case, I would have a difficult time justifying buying and holding this. So let's look at the 10Ks first. Let's see if we get an NT10Q. I don't see any so far. So far, so good. Okay. So they passed the first check. Let's check the 8Ks now. All right. 1.01 right off the bat. 3.03 material modification of rights of security holders. These are scary because they can take away voting rights and other things from shareholders. So always worth looking at those. This cost associated with the exit or disposal activities, that's just saying like if it's an airline and they destroy a fleet, there are costs that they can disclose and deduct in most cases. So I don't really care too much about that because I'm more interested in their lines of credit. So here's a couple. There's DFO right there. Let me zoom in on this so you guys can actually see what I'm referring to. 1.01, 3.03, 1.01, 2.03. Here's a shareholder vote, which again, they're annual, so not a big deal, but always worth at least peeking at once you make up your mind. Here's 1.01, 3.03, and an amendment to the Articles of Incorporation. Anytime that AOI is touched, you got to be cautious. You have to look at that because companies do that to expand their authorized limit, which is the total number of shares they can create, and then they'll dump dilution into the market if they're struggling for cash. Now, shareholders had to approve that, or they had to approve certain conditions for the board to approve it. So that's why it's also important to look at those votes every year. Okay, so I don't want to go too far back. We're back in summer 2025. Just looking real quick here. Let's see what we get here. Okay, here's supplemental indenture, blah, 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 blah. I don't really care about these. These are 2027 notes offered June 1st, 2026. 91.21% or 91.12% outstanding amount. Okay. Not too happy about that, but that's okay. Let's see what else we got here. 7.5% senior secured loan, second lien notes due 2031. Okay, so they're doing the same thing. They're just putting out notes for the future, which they will have to pay. And that money is going to come out of their assets. And okay, 7.5% per year. Okay, notes will mature on July 1st, 2034. Don't really care about that. Bear an interest rate of 7.875%. Okay. Okay, redemption price. Okay, so first call date, redemption price equal to 100% of the aggregate principal amount, blah, 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 blah. So this is just saying that they're going to pay face value, effectively, which is pretty standard. Okay. Creation of a DFO. This is what I care about right here. Information included 1.01. Okay, so they're just classifying this as a portion of that as their DFO because they're creating an obligation for their future in 2031 and 2034 through this the issuance of the notes. Okay. And if you don't understand all this stuff, I'm really trying not to go too far here down the hole, but I just want you guys to understand that it all boils back to these three questions. Is a company making money? If they're not doing it with revenue, they're usually doing it by offering pieces of the company to the market, and that results in dilution, and that dilution comes out of the shareholder pocket. So I want to see good, consistent revenue growth, and if I don't see that, it's harder for me to justify investing in something. Is the company keeping money? So if they have good revenue growth and they have good free cash flow growth, they're able to continue growing the company and reinvesting and buying shares back. That rewards shareholders. If they are having a declining free cash flow and they have a good revenue growth, that means that their obligations are increasing, which means they could have a bunch of stuff maturing that they've loaned out that they have to pay for. Costs of getting goods or something could be increasing. Their operating expenses could be increasing. That's worth looking into how the debt is structured. Otherwise, if they have a positive free cash flow and their revenue growth is good, that's a good company, in my opinion, to at least look a little bit closer, because that tells me the likelihood of this third question being a yes is pretty high. Okay? If the free cash flow is negative, that's not necessarily a nail in the coffin. It just means that we have to look at it and make sure that that's not going to cross down and take out their positive revenue growth, because they don't want their debt to outweigh their inflow. Okay, so more of this, more offerings. Okay. Here's the material modification. Okay. Okay, yeah, right here. So subject to certain exceptions, so long as any preferred stock remains outstanding, no dividend or distribution will be paid or on the common stock or any other shares of junior stock. So yeah, that's February 2026. So that, of course, that depository shares. Yeah, that is a nail in the coffin right there, because that says, hey, investors that have been holding us for a long time, sorry, not sorry. We're not going to pay you anymore. So in my opinion, this is another company I would not invest in. And again, I just look for that current ratio right off the bat. Not a deal breaker, but it's worth looking into initially. Does that make sense to everybody? I hope so. Also, you guys are typing that. Looks like GMM is pushing, so I'm going to move my stop loss orders down, or sorry, not my stop loss, my my break-even orders down to just above my cost basis, which is going to be at 397 now, just for anyone who was on the stream this morning. And I just got that going in the background there. So, hope that makes sense. Snowflake Tammy said yes, enthusiastically. And again, it's very easy to make this stuff a lot more complicated than it has to be, because we're humans and we see a lot of complicated numbers and complicated words. Like, people don't know what Term A senior tranche notes are, and that's okay. You don't have to. But what you do have to understand is that, just like a household, you've got inflow and outflow, and you've got to see the red flags first and then use that as a filter to make sure that the money that the company's making from customers like you and I that are paying for products and services will make it to the investors, and then we want to be those investors. Okay, we are basically a partner on the board. We have to make sure that the company is making money in order for us to get paid as investors. That's the role of an investor. We offer the company money in exchange for certain things like voting powers, dividend payout rights, and blah, blah, blah. And then if that company isn't paying us back, we're not using our money efficiently, and that's why I want to focus on those three things, just three. Is the company making money, keeping money, and are they able to share it with investors? And if the answer to all three of those is no, that's a definite no. and these are in order of priority. Okay? If this answer here is no, if they're not offering dividends, for example, it might just be a growth investment. Okay, it just might be something you have to buy and hold for a long time because the shares will mature. They will appreciate over time. If they do offer a dividend, it's usually an income position if it's a higher paying dividend, in which case the shares themselves might struggle over time, or if it's a really strong growth, it might be both. You just don't know. So in that case, we have to classify it with this question, but this question here is a Boolean, and this question here is kind of a catch. It's a safety net. In case this one's negative, we have to figure out, are they able to offset that lack of revenue by reducing expenses and finding money other ways that are healthy and won't destroy the company long term. Does that all make sense so far? I know we talked. This is a pretty dry topic. I get that it's very boring and it's kind of mind-numbing. But I would encourage everyone to look at a company. Just pick a random company and just look at their stuff. Go to stock analysis. Type it in. Like, let's look at let's look at ILR, right? Just go here. Just see what the company is made of. Look at their income statement. Look at their balance sheet. Look at their cash flow. Learn some of these terms, and I'm more than happy to help you guys learn this stuff. Just put your mouse over here, or I guess over here if it's... Okay, so I guess if it's bold and if it's a link, I guess it won't... what does this do? Oh, okay, yeah, right here. Okay, so revenue, I guess some of those links you can go to a page apparently. And if you look here, it'll tell you what that term is. If it's not highlighted like that, you can just put your mouse over it and this little pop-up will show up. You don't have to learn them all. You want to focus on revenue growth to make sure that it's a positive trajectory. This is not. I picked this company on purpose out of that list. And then the free cash flow obviously is the next top priority that you want to look for. Then you go to the the balance sheet. Okay, it looks like my order on GMM also just reduced just above my break even, just so everyone's aware. Then I look at the total current assets, total assets, and I compare those to total current liabilities and total liabilities respectively. And then I can just kind of look at the trend. If it's not a greater than one relationship, I need to look at the trend and say, okay, well, are their assets declining or increasing? If so, if they're increasing, are their liabilities increasing as well? And are they outpacing the assets? Because that just means that they're owing more than they're making. And the cost of making money or cost of having money for that company is too high. And it is crossing down, so the company will lose money overall. And we don't want that. Because remember, shareholders pay first. The company will survive. There's so many things a company can do. They just throw out smoke screens all over the place and they can shuffle things around on paper. They're going to be fine in most cases. But their shares won't be and their investors won't be. Because you guys are all going to get caught in the crossfire along the way. So I hope that makes sense. I will probably wrap up this one here, just to make sure everyone... I also don't want to risk it with my power potentially going out. But I want to make sure everyone here had enough exposure to the financial stuff and the SEC filings. If you don't fully understand it, that's okay. I just want to make sure everyone here has a basic understanding that a company needs to make money and they need to spend it efficiently, just like a household budget. You have inflow and outflow, and what's left is what generates flexibility, which is wealth. Okay? So for a company, it's no different. We want to make sure that the household is strong. We want to make sure they're making money, spending it wisely, taking advantage of the discounts, reducing anything recurring, getting good interest rates on loans and credit cards and whatever. And all the extra money goes into building up the value of the house and making partnerships, having neighbors come over and borrowing money from them in a healthy way where they get incredible interest rates, but they can further speed up their investments. We want to see all that in a company as well. Okay? So with that said, let me end the recording at least. I'll hang out with you guys here in the Discord, but if you guys have any questions, now is the best time to ask because, again, I don't want to risk it with this power situation. So thank you all for watching the recording. I'm going to hang out in Discord for a couple minutes, and then I'll wrap it up.